Hi guys, and welcome back to the channel. Let's say I come to you with a question. Would you like to buy the stock of company XYZ, which you have never heard before, for $50? Before answering this question, I bet you would like to know a little bit more of company XYZ. In particular, you would like to understand whether $50 is a legitimate price, or it's a scam, or it's a bargain. In other words, you would like to perform some sort of company valuation. But how can you value a company? How many approaches can you deploy in order to value a company? And which is the most appropriate one? In this video, we are going to answer to those questions. So stay tuned and let's start.
But if you're investing, if I'm going to buy a half interest in a McDonald's stand and you're going to run it, or a McDonald's franchise, you're going to run it, I look to the business to determine whether I've made a good investment. And I'm concerned about, whether we have new competition, how we do over the years. But it's the business I look at. When you're just looking at the price of something, you're not investing. I mean, if you buy something, Bitcoin, for example, or some cryptocurrency, you're not looking to the asset itself to produce anything. If you buy an apartment house, you're looking at how the apartment house does. If you buy a farm, you're looking at the farm does. If you buy a whole business, you're looking at how the business does. If you buy a part of a business, why shouldn't you look at how the business is going to do? But people get charmed by lots of action and the fact that things are liquid and all of that. And it does have repercussions back into the market when you get something like, an ETN arrangement on the, supercharged on the VIX. I mean, where you can lose 90% of your money in one day. I mean, that really doesn't belong with the word investment. I mean, it's a gambling.
Evaluation is an attempt by means of data and numbers to define the value of a private or a public company or an asset in general. But why do we need valuation? Because evaluation gives us a rational pair of glasses, a common framework to assess the reality, which should shield us from the risk of a herd behavior and should protect our argument from our own psychological biases. But why did I say should? Because every valuation is far from being completely objective, perfect, and rational. The root causes for valuation misconception can be grouped into three main broad categories. Have you ever read an analyst research, discussed with a friend, or read an article about a company? I would bet so. Truth is that it's almost impossible to approach a company valuation without any preconception, and the extent to which we are exposed to them is unfortunately inversely correlated with the amount of time we spend researching for that specific company. What a model does when valuing a company is basically trying to predict the future. And we tend to believe that the outcome of this process can deliver an objective and perfect result just because we are using numbers as input. But we should not fool ourselves, because we are dealing with the unknown, with the uncertainty, and the outcome of this process can be as good as an estimate can be, which might or might not realize. A lot of time is spent in building very sophisticated models that aims at capturing the complexity of the business and of the reality. But the more we venture into this process, the more the number of inputs and assumptions that we need to make, and the more obscure the result becomes. Do your own research by focusing on the most objective source of information, such as the company financial statement. Try to understand the company's past result by looking at its competitors, and challenge the management forward-looking assumption by looking at the industry, at the peers, and by using the most conservative figure. The outcome of this process will be imperfect and wrong by nature, because you are basically performing a forecast, you are doing an estimate. The only way to deal with that in the process is by introducing a margin of safety, which accounts for your own error and biases. Keep it as simple as possible. It is detrimental to further detail a model in order to achieve an hypothetical additional 5% precision in the final valuation if this comes at the expenses of the control that you might have on the model. As Keynes was used to say, I prefer to be roughly right rather than perfectly wrong. With the intrinsic value approach, you are basically valuing a business based on its fundamental. It means that you are looking at its revenue, cash flows, buybacks, growth rate, and dividends. The most common form is the discounted cash flow or DCF, where the value of a company is determined as the present value of the expected future cash flow. By using this approach, you are implicitly stating that the market will correct its inefficiencies or misalignment between the price and the value of the company over the medium term. In terms of pro, it is based on fundamental and it is not influenced by market assumption or fluctuation. It also fosters a good knowledge of the company since the investor has to study its fundamental before valuing it, and then it forces the investor to take a medium to long-term perspective. In terms of cons, we have that it is often required to make a lot of assumptions which are prone to manipulation, and that it requires a lot of time to prepare the model and to study the company. In the relative valuation approach, you are valuing the company in relative terms by looking at some predefined metrics of comparable asset. By using this approach, you are implicitly stating that you don't want to value the company based on the fundamentals and determine the intrinsic value, but rather define how much it is worth in relation to its peer. Because you think that the market is correctly valuing the sector, but not the single stock. So here an example, since the average PE of the sector is 10, then the company PE is 10 as well and therefore is worth 100, for instance. In terms of pro, we have that this method is anchored on market perception of that specific industry and sector and therefore can reflect the momentum prevailing in the market. Also by construction, there will always be company below or above the sector average and therefore identify as over or under value, and then it requires less exogenous assumptions. In terms of cons, we have that a company can be undervalued when looked at its sector, but still extremely expensive with respect to the entire market. And finally, that a lot of assumptions required in the relative valuation are hidden or implicit. With the real option valuation approach, you are making use of the option pricing theory in order to model the uncertainty embedded in the contingent cash flow by introducing probability. So you are implicitly saying that the market is mispricing the uncertainty. In terms of pro, we have that by introducing the probability, it is possible to weight the uncertainty and therefore to assign a value to assets that otherwise would not be possible to be valued. In terms of cons, we have several assumptions that we need to take, and that since the option derives its value from the underlying asset, there is the need to first value the company, and therefore we might introduce double counting. We are almost at the end of this video, and I hope you enjoy this introduction to asset valuation. In the next videos, we are going to the details of these approaches and explain you how to use them. So if you like the video, please don't forget to give a thumbs up, subscribe to the channel and ping the notification bell. It means a lot for us. So that's it for today. Cheers and see you in the next video.